Prince.
I'm just-
Like Prince in the Revolution.
Gold fleeth the man.
Yeah. Gold fleeth of me.
Gold fleeth the man who
Digging.
take charge of your financial destiny.
Open your hearts and your buy red profit books and turn to chapters 1, section.
It's chapter 2,
Chapter 2,
page 19.
page 19.
Taking charge of your financial destiny.
Taking charge of your financial destiny. Please open your hearts and your books.
We're going to start with a passage from the Richest Man in Babylon. Gold flees the man who would force it to impossible earnings, or who followeth the alluring advice of tricksters and schemers.
Preach.
Who would trust
Trust it to their own understanding.
Yeah, who would trust it to his own inexperience and romantic desires in investment.
Yes, preach.
Let's get that one more time.
Please put it up on the big screen so the congregation can see it.
Gold flees the man who would force it to impossible earnings, or who followeth the alluring advice of tricksters and schemers, or who trust it to his own inexperience and romantic desires in investment.
But that last part is will get you every time.
Get you.
You know, who trust it to their own romantic desires.
Exactly.
Everybody thinks that they can take their dollar and turn it into $1 million.
And I like it, man. It says, following the advice of tricksters and schemers, man.
Following the advice of tricksters and schemers. And you know, and I think that's relevant today.
Yeah.
You know, for the simple fact that, you know, every week there's a new guru, you know?
Yep.
And, you know, it's like, who do you follow? Who's really giving you the truth? Who's really a brand, or, you know, who's really a practitioner?
Exactly.
And, you know, it's hard these days because, you know, just, you know, the ability to create illusions, you know, with technology and all the things that people have at their disposal these days. You know, what was that? I forgot. We were reading that magazine. You know, we were seeing something.
Which one was it?
I don't know where we were, but it was like, now you can rent and be on a plane.
Right.
And make it look like you're on your own private plane.
Yes. So yeah, there's a lot of Instagrammers now that are renting private jets for photo shoots.
But this wasn't even a jet. This was like a prop. A prop.
Yeah.
You can just go sit down and, you know, it's getting out of control. You just really don't know, you know.
Tricksters and schemers.
Richest Man Babylon was, you know.
Absolutely, man.
They were speaking on it even way back when. So yeah, man, it's let's get into the word.
Let's get into the word, man. Well, hey, thank you for being here, B, once again on the Buy It, Rent It, Profit podcast, brother.
Yeah. By the block.
You
got the book in your hand, so I see the Freudian slip.
Exactly. I'm like,
I see the Freudian slip.
The Buy It. Oh man, the By the Block podcast. Yeah.
That book. Let me see that book. So
Absolutely.
everybody on Facebook, this book holds a lot of power.
Exactly.
When you hold this book in your hand, you see it starts to manifest itself through your. You know, you start talking. You start speaking. Buy it, rent it, profit. I mean, you can't help. This book is in the U.S. Library of Congress, people. The U.S. Library of Congress.
Yep. Yeah.
I'll say no more about that book.
You have to excuse the slip. I probably have about 40 copies sitting in my house, man. So
you and me both.
all the books that we be giving away.
We give away, yeah.
So yeah,
we got to give more away. We got to get out there to the schools, man. We got to get this book into the you know.
Exactly.
The hands of the youth. So
yeah, let me start that again. Then I want to welcome you guys to the By the Block podcast, By the Block with Bryan Chavis, where we do teach you how to buy it, rent it, and profit. That's right. You know, we got Bryan Chavis here once again.
Good to be home. We're back in the studio.
Exactly.
Thursday. Once again, we say this every Thursday. Thursdays. It comes Comes quick.
Yep.
Comes quick.
And today, what I wanted to talk about was you've been taking a look at a huge portfolio in St. Pete.
Yep.
And so in your book, you talk about taking charge of your financial destiny. One of the things is the importance of having systems in place. And so you went out to the property and you did what you call a pre-due diligence.
Correct.
We hear about due diligence, but what's up with
the pre?
Yeah,
right.
Tell me more about that, man.
That's a great question. And the pre-due diligence really is it has a lot to do with my lack of a knowledge and understanding.
Okay.
So if you've read Buy It, Rent It, Profit, you know I have a certain criteria of apartment buildings that I like.
Right.
Okay. It's pitched roof, concrete block, no older than 1980 build, whatever.
Correct.
But what happens when the market, does you have to play the hand that, I think I said that in the video yesterday. You have to play the hand that's dealt to you. Mm-hmm. So what happens when the market doesn't have that type of asset? But you need to be in that particular market. So for me, it's more about being in the market because, this just falls back on the teachings of the Buy It, Rent It, Profit.
Yep.
Is I've never bought buildings. I'm buying demographics and psychographics. I'm buying something that my prospect tenants would rent.
Right.
So my focus is not the building. My focus is actually the prospect tenant. So this proves my theory that I am who it shows. This is why I'm a practitioner.
Right.
Because we're just not here regurgitating stuff we've gotten at some kind of seminar or read some books, and now we're doing a podcast, and because we love real estate. This is what we do. This is who I am.
Exactly.
And this is my point, is that if I bought buildings, then I have a set criteria, and I'm out buying buildings. But this is why I tell you, I've never bought a building. I'm buying it based. Real estate for me is understanding the multifamily industry like I do, because I come from the multifamily industry. I'm a student of the of the industry. It's understanding that this business is about demographics and psychographics of your prospect tenant. And so when you've identified who your prospect tenant is going to be, then you figure out the housing that fits those needs. Mm-hmm. And then you go find, the assets that fit the demographic and psychographic that you identified those needs. And so in the case of downtown St. Petersburg, Florida, you're not going to find, I found Park Plaza, and there's been a few others that, we've put a bid in, we lost, but you're not going to find a lot of that concrete block, garden style type asset. So you have to kind of play the hand that's dealt.
Right.
And the hand that's dealt are these older wood frame homes.
Okay.
And so it forces me to bring in more expertise to the due diligence process, because my scope, my understanding is limited.
Right.
With that type of product. So I'm bringing in project manager, big shout out to Joe Ebanks, Cash Man, who comes in and lends his expertise from the wholesaling and flipping and rehab side. That's flipped a lot of those bungalows and and deals with those older homes, wood frame homes, bringing him in, bringing the contractors in, understanding, what type of ADA compliances. If I rehab this unit, am I forced to rehab it up to code? There's a lot of things that so you have to do a pre-due diligence before you get involved. So I kind of have an idea and understanding, maybe I don't pursue the entire portfolio. Maybe I only pursue certain pieces of this portfolio based upon the information that I'm getting back. So before I get too hot and heavy with a full-out due diligence, maybe I figure out a way to, to tweak the portfolio, or maybe my offering, or, put together my team a little differently. Right. This team might be a little bit more top heavy with contractors and maintenance technicians than it normally would be on a regular brick, pre-1980 build.
Exactly.
Pitch roof. So,
well, I love it, man. I mean, this is why you talk about the importance of systems on page 19 in your book. And like it says, even in The Richest Man in Babylon, this is a book that's written in, I don't even know when, AD. Forcing impossible earnings, following the alluring advice of tricksters and schemers.
Correct.
What would you say are some of the alluring advice of tricksters and schemers can you find in investing in multifamily deals? So I know you're getting things like OMs from other companies and so on and so forth. How can someone get fooled and be kind of seduced into?
You're probably not going to deal with as many tricksters,
Right.
With multifamily, or schemers.
Right.
What you're dealing with are salespeople. So, and some could be as, category has as tricksty or tricksters or schemers, but at a whole, the industry, especially when you're dealing with multifamily institutional grade assets, you're really dealing with professionals.
Exactly.
And so as a whole, the industry is really, insulated with some great, you got CBRE and Marks and Millchap and Franklin Street. You're dealing with a lot of, highly skillful individuals, not so much tricksters and schemers. Right. However, you are dealing with a salesperson.
Right.
And, by definition, the way I was taught coming up, salespeople want to make money from you. So anytime someone wants to make money from you, you have to consider and take their advice with a grain of salt.
Right.
So, you have to, you have to do your research. You have to do your own research. And, you don't want to go in with just, their understanding or the broker's pro forma. And because the broker's pro forma is gonna, it's gonna be skewed towards the seller, and it's gonna typically, where they, where the question marks are in the property taxes, and typically what it takes to operate it, per unit maintenance wise, vacancy rates, things like that. So typically those are the areas where you'll see the inconsistencies. And if you're not doing your own homework and you're just taking everyone for their, for the gospel truth, this is where, you'll back yourself into a deal, and, and this is where, you'll have issues. This property's not operating the way the pro forma said on the, on Monday when you show up with the keys and it's now it's your show. You're like, oh, wait a minute. These vacancies are slightly higher than what I underwrote. So, you just have to understand where the discrepancies are. That's why I say, when it comes to underwriting, to me, people think the most important part of underwriting is really understanding how to underwrite. And that's important. Having the right model. Right. Because a lot of models out there that you can buy online, but the vast majority of those models are garbage, to be honest with you. They're not calculating the IRR correctly, discount rates. They're not really factoring the big picture. If there's no budgeting module in there built in, waterfall structure built in, if it's not properly calculating IRR, if there's no way that you can, factor in discount rates and things of other opportunity or like investments and compare them side by side, then in my opinion, the model may be lacking. It's very important to understand the underwriting process and having the good tools. Right. Carpenters really only as good as their tools. Right. But for me, what I bring to the table, and I feel like, the underwriting process is, that I bring is that I can't be fooled in that process because I'm approaching it from an operator standpoint. So for me, the most important skill set, as a syndicator or an investor, is have that knowledge of a property manager. Right. I think that's the most important, because you can't be fooled in your underwriting when you actually know what it takes to operate that property from the operational boots on the ground perspective.
Hey, that makes sense. So in the book as well, it talks about having romantic desires of investments. You submitted an OM earlier this week with a cash on cash return of around 6.8, I believe. And some people would look at that and say, man, that's, I got all this money. I can get a 12% return on something else. I mean, speak to that, man. I mean, what's the difference?
Well, and if you can, please hit me to it. I'm all in with you. Yeah. With that 12% return. But what, I was in a very private event last night that was really only for a specific set of individuals, where Fannie Mae, Freddie Mac were actually in the room. Yep. Wasn't supposed to be filming, but I filmed a little bit of it on Facebook. Big shout out right now. Want to shout out to our live stream. People chiming in from Facebook. Greg, TB Ria. Big shout out to the TB Ria family. TB Ria family. So I wanted to do that. But yeah, so we're in this private meeting with, investors. If you haven't spent over $5 million in the last year or so, you aren't invited. And that topic came up with a lot of the investors, other investors in the room. And so it's like, you have to understand when someone says I have an investment and I'm getting 12%, I'm getting 8%, I'm getting 9%. Anytime you're getting an oversized return, there's risk associated with it.
Okay.
So for me as a syndicator, there's a bit of salesmanship involved with this. Is I'm not selling. I'm not out there looking for high cash on cash return.
Right.
I foresee a softening in the market coming. We have an election coming up. We have a lot of uncertainty. We have tariffs. We have, trade wars. We have wars in general. A lot of uncertainty, continuously dropping interest rates that might find themselves sub 3%. A lot of uncertainty in the market. So for me, I'm focusing on risk diverse investments that are not going to throw off a ton of cash flow, but what they are going to give you for where they lack possibly in cash on cash return. And let's understand that just because you might be lacking in cash on cash return doesn't mean I can't make that up on the appreciation of the asset or straight line depreciation and all kind of other, tricks of the trade that, that real estate offers.
Of course.
But just staying with that focus of, you're only offering 7%, I can get 12% elsewhere. That mindset. Yeah, but, we're in a core market. So when the market does change, what areas and what demographics you think going to be able to bounce back the quickest. And typically, if you're saying I'm getting 12% cash on cash return, you're probably somewhere on the outskirts of a core market. From which, guess what? When the downturn happens or there's a softening in the market,
right,
your prospect tenants demographics are going to be the first to be hit. Hours, wages are going to be cut back, So, delinquencies are going to go up. And so, are you hitting those target prefs that you have as a syndicator? Probably not. So, at the end of the day, this is chess. It's not checkers.
Absolutely.
Unfortunately. So, there's there's a ton of strategy behind this. And that's why I'm always preaching property management. It's because as a property manager, you understand this. Any property manager listening to this podcast understands that it's the buck starts and stops with the tenant.
Right.
That's where the income comes from. An empty stable stays clean, but there's no income in empty stables. King Solomon said that. Richest man who ever lived to date. All right, since we're on this richest man in Babylon, let's take it back to 2,000 years. These principles are the same. Empty stables stay clean, but there's no income in empty stables. So you can have an apartment complex, but if it's empty, you're not collecting rent, or there's there's horses in the stable, and they ain't paying income. They're dirtying up the stable, smelling up the stable, and they're not producing income.
Right.
So I can have an apartment complex and fill it up. There's a big difference between economic vacancy and physical vacancy. So, just because you got people in the unit, if they're not paying rent, you're not collecting income.
Oh, that makes perfect sense. So yeah, absolutely. So, don't be romanticized by those high returns, because you're going to need a whole nother set of systems in place, to deal with all those problems.
That is correct. Yeah. Be careful. I get a higher return. Be careful, because higher return means just more risk.
Exactly.
So, and if you can get that higher return and you're willing to risk, that's fine. But, again, it falls back on where you, for me, the investors and the money that I'm raising,
right,
the investors are not really hurting for cash. These are high net worth individuals.
Yep.
What they look for is stability, efficiency.
Right.
And when you talk IRR, you talk efficiency, because that is the measure of IRR. Is if I put money into a project, how efficient is that project in getting my money back?
Exactly.
If you want to talk IRR, and a lot of people, they dance around this.
Yep.
Because a lot of people don't know, how to articulate IRR.
Why don't you give it to us?
So I just did. In a nutshell. If I give you an investment, okay?
Yep.
If you have two investments,
right,
we can have two investments, right? Me and you both put $250 in those investments.
Correct.
Right? Over a 10-year period. They both would give a 17% IRR, and I'm just throwing a number out. Let's just say it gives a 17% IRR. Investment one gives you $150 every year for 10 years. and then $1,500 at the end of 10 years.
Okay.
Investment 2 gives you nothing for 10 years, but then $250,000 at the end of 10 years. Our IRRs can be both the same.
Correct.
17%.
Yeah, true.
But are they the same?
No.
They're considerably not even close. One's giving you $1,500, one's giving you $250,000, but they both show a 17% IRR because they both show it's a measure of efficiency. They're both saying they're efficient at giving you your money back. Right. So the point is that IRR is about measurement of efficiency. So you need other calculations like cash multiple, net present value. There's other, and then when you're talking about multifamily, you're talking about cap rates and cash on cash returns. But there are other measures more than just one to be able to show, how efficient something is. So you're really looking at it from various different perspectives. So when you're talking about getting involved with portfolios and apartment buildings, even someone like me, you're having to do pre-due diligence. You're having to do certain things, to be able to evaluate the asset properly.
Right. So, this comes back to you taking charge of your financial destiny. You're not supposed to just rely on the paperwork that you get from the broker or, the numbers that you hear from the actual apartment owner thinking that it's worth a certain amount of dollars. You have to do your work. You have to do your own research.
Absolutely.
How does one get this type of education, being able to work alongside you, B? I know we have the Multifamily Matrix, so tell us more about that. We just had a young lady join us, Madeline, which is exciting. She's interested and she's going to be growing her portfolio to 50 units in 2020. Tell us more about the Multifamily Matrix and how people can gain that knowledge.
Yeah, the Multifamily Matrix to me is is developed to to really do what we're doing now. Is really to to help individuals strategically grow themselves as individuals, level up, develop themselves in the fields of property management, asset management, syndication. The Matrix is, to me, it's the most, this is the place to grow. It's the place to, if you really want to learn about this industry from practitioners, this is where it's where you want to be.
Absolutely. And we're having a lot of fun inside the Matrix. We've been adding more and more courses. Each week we do coaching sessions. We keep adding those into the system as well. So it's just getting bigger and bigger and bigger. So we definitely invite you guys to join us. Go to bryanchavis.com/matrix. Once again, that's bryanchavis.com/matrix. And you can get started and work with us each week. We have weekly group coaching. We have software and systems, training on marketing, all of your forms, apartment analyzers, you name it. And we're here to help you reach your goals.
Due diligence checklist. Since we're on that subject matter,
Exactly.
Yeah, I'll probably shoot a quick video again of the whole checklist of the due diligence. But how do you put together your team?
Correct.
So understanding how to put together your team. And again, understanding your team and the complexity of your team is constantly changing depending on the type of portfolio or type of investment that you're looking at.
Exactly.
So, just again, the knowledge is key.
Exactly. Well, we've got some work to get to, man. So once again, B, thank you so much for joining us on the podcast, brother.
Absolutely.
And I look forward to speaking with you next week, man. And take care of yourself.
See you guys next week.